Hi, welcome to today's webinar. You're probably all familiar with how this works, but just in case, I want to make sure that you know this is an interactive webinar. So type in questions as we go through, and I'll be happy to address them throughout the presentation or after, but we want to make sure this addresses any of your questions, so be sure and type them in as we go. I'm very pleased today to have a number of people. You won't, like some webinars, hear from me on this particular subject too much. You're going to hear from some actual experts on the topic. We've got Bill Hughes. I'm going to let everybody introduce themselves here in a minute. We've got Michael Bull, and we've got Will LeMay. And before I have them introduce themselves, I wanted to give you an overview real quickly of what we're going to be discussing today. I'm presuming, since you signed up for the webinar, that you or a friend of yours or somebody you know may need access to creative capital in the next year or so as a result of either your loan maturing or as a more holistic solution to the loss of income due to COVID. And so we're not talking about COVID relief here. We're talking about longer term solutions for additional capital. And this is for times when your typical bank lending relationship won't work. And with a lot of COVID affected properties, that's going to be the case. So for that reason, we'll primarily focus on hospitality and retail, as these we think are going to be the toughest to find capital for. So, and Bill Hughes and Michael Bull are very deep, have deep roots and background in this side of the business, and they're going to share their insight into the capital available. Will is also going to give us an overview of the maturity landscape for CMBS anyway for 21 and 22. And for those of you who signed in for distressed investment opportunities, you might pick up on some of that also. So Bill, why don't we start with you? Introduce yourself, if you will, and then we'll have Michael introduce himself.
Thanks, Ann. Let me try to do this real quickly. I'm currently a consultant for BH Properties. BH is a real estate investment firm funded by a captive single-family office based in Los Angeles. Our focus is in the western portion of the United States. We actually own and operate real estate in 17 different states. Beach, we've been in business for around 30 years as we are today, and we own just over 10 million square feet of commercial real estate, plus about 2,100 apartment units. We work in all property types, from office to industrial to retail. I already mentioned multifamily. We also own interest in lease fee interests in a number of major properties, ground leases in a number of major properties, including Class A office, multifamily, and hospitality. Before doing business with BH Properties, I was with Mark Smilachap for about 25 years, just under 25 years. Where I was responsible for their debt and equity platform on a national basis. And that's my background. I retired 2 years ago, and now I'm working closely with BH Properties.
Yeah, I always wondered how it really works. That's how it works, right? You go back to work somewhere else.
That's when you run all your life, it's hard to sit down. So I'm enjoying this. BH is a great firm. I get to keep my hands in structuring deals and doing deals, and that's what I like.
It's wonderful. Michael.
Yes. And hi, Bill. Well, glad to be on this with you guys today. I'm honored to be here with you. And just a brief on who I am. I'm a 35-year experienced commercial investment sales broker, and I own a company called Bull Realty. We're regionally based in the Southeast. We've been around for 22 years, and we have teams who focus on each specialty type. We do have a hospitality group who was really slow last year, and now that they've gotten very busy. We have a retail group that sells retail properties. I lead a team that sells office buildings, and we've seen a lot of incredible activity there on the government leased buildings and on the medical buildings. A little bit slower on the regular office buildings, as you might expect right now. So that's my experience as a broker. And then some people know me as host of America's Commercial Real Estate Show, where we've been doing a show every week for 11 years. And it has about 60,000 listeners a month. And it's on your phone, and you can listen to it whenever you want. In fact, some people I think don't like me because they listen while they're either in traffic or exercising. They don't like either. But that's who I am.
Thank you. Will, why don't you introduce yourself, and then why don't you just go right into the giving an overview on the maturity landscape.
Great. Thanks, Ann. Great to be here today. And I'm Will LeMay, and I work at First Service Solutions with Ann. Just joined back up with her a few months ago. Spent the last 20 or so years in lending and servicing shops, running servicing shops, and asset management shops, all commercial real estate, anywhere from, all property types, primary servicing, master servicing, special servicing, most recently, other forms of investment servicing, including corporate debt, but always with a real estate bent. And so the last year's been very interesting because when I just came from a lender side and can give a sort of a lender perspective of how the lenders are looking at distressed debt and potentials for creative capital and takeouts. And mentioned that we're going to spend some time on what is driving the need for capital and why that capital may need to be creative, more creative than in past years. Just to give you some ideas about maturities coming up in the CMBS world, again, focusing on hospitality, lodging, retail, and then a little bit on office. In 2021, there are 29 loans remaining to mature, or about $560 billion in, $560 million in outstanding debt. Retail, there's 116 loans left to mature this calendar year, for $2.5 billion in outstanding principal balance. In office, there are 64 loans with $1.6 billion of outstanding principal balance. In 2022, there's a lot of activity where you will see deals that will be negatively impacted through the COVID period, sort of an unstabilized NOI, and the anticipation is that using traditional metrics, those deals won't underwrite to refinance under your standard 10-year 80, 120, or 125 takeouts. So we're going to have to be more creative, or the industry is going to have to be more creative on how to get those loans out and into new debt, and it's going to be a combination of debt and equity. In 2022, for instance, there are 151 CMBS hotel loans for $2.8 billion of outstanding principal balance. Retail, there's 309 at almost $6 billion that is maturing. And in office, there's about 230 at $6.2 billion. So there's a lot of need just for what would be considered normal, everyday loan maturity takeouts that are going to be more difficult because we don't have stabilized NOIs. Those entire sectors have been destabilized, and with a level of uncertainty, we're already starting to see that there may be some difficulties, certainly taking those deals out because of when they were done 7 to 10 years ago. We were in a rising market.
Bill, why don't we have you start with, I started out the whole thing by saying that we were going to probably focus on hospitality and retail, but why don't you give us a good overview of what you're seeing generally? This is what people signed in to hear. What are you seeing generally in the capital markets, and what kind of capital do you think is available for not only the loans that we'll just recap, which is, by the way, a lot of maturing loans, but also just if people want to, stabilize their property through a new capital solution because of COVID. So, Bill, why don't you give us a good overview on what you're seeing in the market?
Sure, Ann. I mean, it has been and will continue to be for the foreseeable future sort of a story of the haves and have-nots. So if you've got the right piece of real estate, it's still pretty easy to get financing in place. If you've got a multifamily property, obviously the agencies are very active, life insurance companies, commercial banks, everybody will do those. If you've got an industrial property, sort of the same thing. While you don't have agencies, certainly life insurance company, commercial banks, there are funds out there that will finance those. Pretty simple stuff. It gets a little bit more complex when you're dealing with retail, who might have been impacted by COVID, and is most certainly impacted by purchase habits, the way we buy things. Certainly office and the unknowns of the future of office. Michael was just talking about that before we came on. And certainly hospitality. But there's been a significant shift between where we saw this marketplace in March of last year, where we saw this marketplace 6 months ago, and where we see the marketplace over the last 3 weeks or so. There are lots of dollars flooding the marketplace now to provide some form of relief for investors that need some different way to finance their property. Obviously, I'm going to let you talk about how the servicers are dealing with extensions in the CMBS arena and whatnot, but all lenders have been a lot more patient this go around than certainly were during the great financial crisis. Part of that is stemmed by the government. The feds aren't on banks the way they were. Regulators have eased off pretty much all of lenders to allow them to work with investors and sort of push out. The general belief is that things are going to continue to get better, whether it be hospitality, where March of last year we thought that the hospitality sector was going to take discounts of 30 to 50%. Where we saw these properties really impacted by COVID and ongoing effects of COVID and the economy. So what I'm going to say today, and I'll give you an example. I'm going to say 6 months ago, if you had a hospitality deal, trying to find debt would have been a challenge. We were just talking with an individual yesterday, a good leisure-based hospitality deal. They're looking at pricing today, 60-65% loan to value, well located. Once again, leisure travel, price that they're getting pricing somewhere between 4.25, 425, and maybe 450 basis points over LIBOR, which in any market is pretty darn good. We've seen that shifting. So what we're dealing with at BH Properties, and I hate to use the term rescue capital anymore. I'm sort of tired of the term rescue capital. I'm using it, trying to change that to transitional capital that we're looking at in the marketplace, and that is bridge lending, mezzanine finance, and sort of longer term, certainly pref equity that can you structure in a transaction. And we've seen both availability of that financing become much greater and much freer, and certainly the pricing to have come in where we were looking at spreads of as much as 1,200-1,400 over, to now I'm talking, generally speaking, spreads of 600 to maybe 800 over, clearly be dependent upon what you have. So when I say have and have nots, if you've got a business-based hospitality transaction in an urban big city setting, you're going to have some problems financing that deal. But the same token, if you've got a hotel, leisure-based hotel in a travel destination in a Florida or any other travel destination, you're probably going to do pretty well and have access to capital. And you're going to see the cost of that capital has certainly come in over the last 6 months. We structure bridge financing, bridge typically 2 to 3 year financings. You should be able to get that today, as I say, reliably, maybe 600 to 700, maybe even inside that. But it really depends on the asset. It depends on the asset, whether it's hospitality, whether it's office, whether it's retail, and it depends on what the operating income looks like today versus in 2019, and is it coming back? We think that some will come back, some won't. Obviously, in the retail sector, and I know I'm jumping around here a little bit, but there's a lot to be said in a few minutes. In the retail sector, we're seeing big box users shrink, so they don't need as much space. That doesn't happen overnight. It's going to happen over years. We're going to reinvent uses in retail centers across the country. But once again, it's going to take a while. Same with office. No one really knows. I heard 2 stories today. One was office, we've got too much office. It's never going to come back. And then I heard someone talk about the fact that, hey, we're going back to the office after Labor Day. Everything's going to be back to normal. Things are going to do well. And lastly, I was at a lunch yesterday and heard somebody talk about building more office. So office is not dead. Retail is not dead. Hospitality is not dead. It is totally based upon location, and its use and its viability. And I'm amazed. I'm really amazed at how quickly this market has come back. Because as you recall, back in March of last year, lenders they were putting the brakes on. They didn't know what to do. They didn't want to lend. Of course, there were always those exceptions where you had 100% leased property and it had a good history and it was drug, grocery, anchored retail center, for instance, that it was doing well. But that's kind of where we've been and where we are today. And I suspect the marketplace is going to continue to improve for those that need capital in the marketplace. Our firm, BH Properties, we're in the marketplace to provide all those services. We'll do mezz debt, we'll do prep equity under the right transactions. We're talking with clients about various different options, and we'll buy the asset if we need to buy the asset. And we're not the only ones. There's a lot of money out there for the right deal. So I'm going to stick to my story. It's have and have nots, and that's where the market is.
Well, lots of questions, actually, some questions coming in and some questions as a result of that. But before we get into those, what I want to do is have Michael give your view on, everybody has a slightly different view of the market and you focus on a slightly different component of it. So talk about what you're seeing, and then I'll start taking some of these questions for all of us.
Well, I'll take the Leonardo DiCaprio kind of view. I concur with Bill. Concur that there's a lot of equity. Yeah, there's a lot of equity out there, and as a broker, we see, we're seeing multiple offers on properties when we take them out to market if they're the right property. The single tenant net lease world with long-term leases and credit tenants is on fire. Cap rates compressed. We're seeing multiple competing offers on medical office that's stable. We're seeing multiple competing offers on government leased office buildings. We are seeing a really uptick right now in the last month we've noticed in land around the Southeast for all types of developments, from student housing to even hotel, believe it or not. And So we're seeing a large uptick in land sales and interest in land. And we're in the Southeast. We're headquartered in Atlanta, so it may have something to do with where we're located. But that seems hot. On the office buildings, of course, a lot of the high-rise office buildings with elevators are empty. They're not in use. That spooks lenders and buyers and investors, not kind of unsure what's going to happen with demand for office space. But we're seeing some buildings that are selling. We're working on a deal in a Southeast city that has a lot of vacancy, and it's selling at a good price, and it's it's the largest building in the city, and the buyer's excited about it. We're working on a small office building, about 8 million in West Palm Beach, fully occupied, and it didn't get multiple competing offers, but it has a buyer and a backup now, and but it's 100% occupied. Everybody paid through COVID. So to Bill's point, it's really dependent on the exact asset, where it's located, and who the tenants are as far as demand. But I'm hearing the same thing Bill is on the office sector as far as the use. I'm hearing some people say office is dead, and it's going to take years and years and years, especially in cities like Chicago and New York. I disagree with that. I think we're social animals. We're going to be the managers, the owners, the investors are going to want top line and bottom line numbers. That's going to mean productivity. That's going to mean collaboration. I think the office market will come back, and depending on the building and the location, I think it could be a year to 3 years in some of the locations, depending on the economy. But I think the office market will come back as well.
So let's use an example. I want to ask Bill and Michael and Will, if you have anything to add, go ahead. But I want to let's say that you have a hotel. I think every time I've heard anything, I think the one city everybody agrees is probably struggling the most, or one of the ones, is Chicago, right? So if you have a hotel in Chicago that's largely dependent on conference travel, and your loan, and you got a CMBS loan. Your loan matures this year, first of all, I know there's no way to know without knowing the sponsor, and there's many variables to that equation. But in general, are either you, Bill, or you, Michael, aware of something that could potentially take out or offer the borrower some debt on, a hotel in Chicago that's largely dependent on conference travelers?
Michael, I'll let you do that one.
No, I don't, and we don't. We do some capital, but most of the capital we bring to the table is equity. But as far as interest in those types of hotels, I think unless there's another use for them, we're not seeing much interest in those hotels in our hospitality division. But as Bill mentioned earlier, things are changing pretty quickly, and what we saw 2 months ago is different today. Depending on the individual asset, I would explore every option.
And I will say I second what Michael says. It really depends on how that hotel is fared during the COVID test, where it was in 2019, what the viability is. If it's just convention travel, you're going to have a difficult time. But it also depends on what the current debt is and how it's underwritten, and what the today's value is, perceived value is. There are funds out there that are more high-risk funds that would do a deal today. They wouldn't do a deal 6 months ago, but I suspect, and I can't give you the name of one, but I suspect there's a fund out there that would take on that financing, depending upon how it's underwritten and what the underlying value of the property is. And that's, once again, as Michael says, it's really very specific to that particular hotel, its location, and what the future looks like. We know that business travel is going to come back. We know that convention bookings are going to come back. As a matter of fact, I heard yesterday that there's a number of big conventions booking and getting in line to book in Las Vegas. So they're coming back. It's just a matter of time, and you got to build that into your underwriting. So it depends if there's enough room to do that or not.
Well, I got to jump in there. I just got my second takeaway from this webinar already. Will's was the first one with all the numbers of maturities. That's incredible. But Bill, I love that. The COVID test. That's what this was. It was a test.
Yeah, and
I like it.
yeah, it was a test, and you know, let's just, I mean, what we're dealing with a lot too are people with those kind of hot hotels that we get COVID relief, or COVID relief kicks the can down the road, and now you're facing a maturity with not only, you know, the lack of maybe ability to get just reasonable debt to take it out, and also the deferred amount that from COVID relief is all tacked on. So, you know, it's a challenging time. Um, Will, did you want to add anything to anything we're saying? Yeah. First. We can't hear you, sorry.
Sorry about that. I put myself on mute so you wouldn't hear me coughing. I think that one of the takeaways, and from the scenario you presented, is for those particular hotels that have been affected by COVID, they were otherwise performing, and so they have 2019 and before to prove themselves. They're now maturing. 2020 is a dead year. Really, what they're going to need is time. And I know you're going to talk about this a little bit later, but there's really two ways to get that time with the existing equity structure, and that is you can either get an extension of your current loan under certain terms, or you can go to transitional bridge financing. And while that's likely to be more expensive, given the right opportunity, what I'm hearing, what I heard Bill say earlier, is that financing is starting to become available again, more so than say 6 months ago. But where it's just time related and there's not a true long-term value erosion, there are going to be ways to buy time. It may be more expensive than folks are would prefer to do, but it should preserve the equity in property.
And do you, Bill and Michael, both really, and I started out by saying I thought it was mostly retail and hospitality that will need more of the creative solutions than standard, you know, call it bank debt. But are there other properties like office that might also still potentially be in that category? Or what do you think which property types do you think are going to have which are the have-nots by property type?
Well, I think that, you know, I think it impacts office as well. You know, for so long in the energy corridor in Houston, a energy-based firm who needed 150,000 square feet would lease 250,000 square feet. Well, now not only do they not need that additional 100,000 square feet, but they don't need the 150,000, so they're trying to downsize. So we see all this subleasing going on. In every market, we see a lot of subleasing going on. So that impacts, obviously, the ability to finance a deal because we're looking hard at that when we're doing a transaction. But financing, whether it be bridge or, you know, maybe mezz, of course, here's the problem. If you go to a mezz or pref equity, you still got to get your existing lender to approve it, right? Even though you could theoretically provide pref equity, you'd want the lender approval, because if you're the pref equity contributor, you have to take over the property. You don't want to be at odds with your lender. So you need to make sure they're in shape, and they're going to be concerned about, what is the money for? I mean, are you investing in real estate? Are you taking this money out and putting it to some other piece of real estate? All those things come into play. So, you know, you can't look at one scenario and say, yes, it works, or no, it doesn't work. Every one of these properties has its own particular issue. And that's why we've got to be open to these. And when you talk about rescue capital, that's why a lot of people use that term, is, you know, it solves a lot of particular problems with a property. But it's still a waiting game. It's still, how do I get from that transition? How do I get from today to 3 years down the road, when I think the marketplace is going to be substantially better It's going to right itself, and we're going to be in better shape.
You know, I like the word transition. I've been looking for a word to better describe, and I think in my e-blast on this webinar, I called it creative because I couldn't think of a good word, but it really is transitional capital, because in the, you know, the '08 downturn, you needed really creative solutions. Here, these are for the most part, I think what we're running across are otherwise really good performing properties. And they got hit with, you know, everybody got hit with COVID, right? And they got the COVID test. And so here they are now, and they're facing a maturity right after that. And that's, you know, you look at historical financials, and there's, I don't know how anybody kind of underwrites that, you know. So transitional capital is definitely a good word to use. Will, you might give a two-minute explanation. You know, CMBS loans are, by nature, they do not allow for any kind of transition, movement, changes, nothing. I mean, they're meant to be 10-year steady fixed, you know, well, whatever the term is, but sometimes 10 years, steady fixed properties with no transitions. But we're starting to see a lot more use of CLOs, and we're starting to work in the CLO market a lot more because the CLOs allow for these transitional type properties. So I don't know if you can talk about that for anybody
Sure.
on this call. You're starting to see more of that, I think.
Sure. So basically, CLOs are another tax benefited structure like REMICs, which is the CMBS structure. But what CLOs allow is, in particular, the CRE, commercial real estate CLOs, it allows you to take what would have otherwise been balance sheet bridge loans, these, you know, 2 to 3 year transitional bridge loans that have traditionally been very expensive. For instance, they'd be used in just what we're talking about here. You need to re-tenant a space, a retail space that's been hit by COVID, you know, tenant bankruptcies, or you know, spaces going dark. You've got hospitality and lodging where, you know, they got a big PIP coming up and you just need to retransition them, maybe a flag change. Office, you've got big tenants rolling out and you need to reconfigure it. So you would take that type of bridge lending, put it in a tax benefited structure, and allow that to be securitized. While it's not as limiting, it looks a lot like CMBS, can feel a lot like CMBS, in that it provides the same type of proceeds, the same type of you know, securitized structure. It allows more freedom of the capital. It allows more capital to come into the marketplace because you get more institutional capital involved with the investment grade bonds or loans that come out of this. But it comes with more freedom than CMBS, and it does allow these transitional loans, transitional financing, to go into a tax benefited structure for investors. So I think they were really starting to hum in 2019. Then 2020 happened, and nobody was doing the bridge loans to sort of feed the CLOs. Now I think the general belief in the market is that there's going to be so much need for bridge financing that people don't have a big enough balance sheet to put all of that and keep it on their balance sheet even for 2 to 3 years. There's going to be a need to finance out in the capital markets those bridge loans, and CLOs are really the only thing we have going to do that. So I think we'll see a ton of that.
What do you think, Bill?
Well, I think we will. I think we contemplate, depending upon how much bridge financing we do, we've contemplated a CLO. You know, to be able to make that work, you probably have to do a CLO of about 350 million, maybe 400 million to cover your cost to go to marketplace and make that happen. So yeah, we've looked at that. I will tell you that.
And it seems like ultimately for people on the phone, what that means is ultimately at the end of the day, more capital available, which in theory drives the prices to be a little more competitive for the owners, but it's still transitional capital. Michael, do you want to add anything to this?
I have a question when it's the right time for Ann and you and Will. If somebody has a CMBS loan and it's in default, and someone wants to buy the property, will the CMBS lender with a special servicer let them pay that off if it's in the period of time where they're not supposed to be able to do that without a big defeasance fee? Are they going to drop the defeasance fee?
The answer is, well, the simple answer is generally no. But if there's no other way to, so let's say you have a property, a hotel in Chicago, and it's clearly today got more debt than the property would support today due to depressed COVID prices, and the loan matured, or it's going to mature in a year or two, and it's a reasonable expectation by the servicer that there's no other real way out, and this is probably the best resolution for everybody, then they would consider it. But I've certainly, if I'm in a general setting, sending a message about waiver of defeasance, I say the answer is always no, it really is. But on an exceptional basis, there are potential, you know, they're like everything, right? It's circumstantial, but let's talk about, well, I'm sorry.
Yeah, no, I think in general that what we're seeing is we're not seeing servicers take long-term losses for what they might consider to be a short-term uncertainty. So when they allow defeasance to be burned off, basically forgiven, say 4 years from maturity, they've taken that loss. The trust has lost the money. There's no chance of getting it back. They're much more likely to let it limp along and sort of hope that a better deal will come about.
Yeah, that's the best summary, is that they and if you were the investor, I tell everybody that is calling and wanting access to, you know, buy properties at discounts right now because of the depressed values of COVID. I explained to them, if you were the investor and you had invested in this property, right, and you could arguably think that you could get out whole if they waited a couple years, and instead they sold it today and passed a loss through to you based on the discount, based on today's value. You wouldn't like that as an investor either, and that's what they're, you know, that's what they live under. So very rarely are there losses today. I should probably talk real quickly about, so what do you do as an owner if you have a loan and it's mature, and you look around. I've heard people, we've had people do this. So they look around to find out available capital. Say it's again a hospitality deal, and I'll use Chicago for consistency in the story. So they go out and they shop around to see what they can get, and they're of course not pleased with the terms because it's painful right now. It's not your typical, you know, bank loan. And so then we start talking about, okay, what can you do with the servicer, the special servicer? And in the old days, I'd say pre-COVID, I used to say an extension of a CMBS loan should be almost the lender of last resort because it's painful. They're going to require a pay down of the debt, typically a 1% fee for every year you extend. And so I always kind of said, view it as a last resort. But in some cases right now, what we're finding is that's not such a bad, those aren't bad terms considering the alternative. So in some cases, I think what owners may wind up doing is maybe extending the existing loan another year and then getting transitional financing, but they certainly should shop around for the traditional financing first. Okay, I think I've incorporated the questions into our session today, and I don't have any other pending. So let's go through. Here's what I want to ask you all. You know, these, I hate these, but these parting, actually I love them, so that's why I'm going to do it. But these closing words, and I didn't give anybody any heads up on this, so it's going to come. It could be completely off your top of your head. But if we talked yesterday, day before or something, and we talked how 30 days ago versus 2 days ago, there was a big difference in the optimism, I would say, right, of the market in our recovery for COVID. So it changes all the time. If you had to predict and give your opinion of where you think we're going to be at the end of the year 2021, not relative to the virus, nobody could do that. But what I mean is, do you think we will continue at an upward trajectory, or do you think there'll be another, you know, big fallout before we get there? Just, just your thoughts. I'll start with you, Bill, I guess.
Thanks, Ann. Well, I think the answer to that is highly dependent on the feds. One, how they continue to stimulate the economy and support the economy. Two, how they approach the banking system and allow bankers to extend and make decisions on credit. I think three, how quickly we get through this COVID thing with vaccination or herd. Uh,
Community.
yeah, thank you. I was going to say herd mentality. How quickly we get through this. I, I I know that there's a lot of money out there. We see many funds out there. As a matter of fact, I've read over the last couple of days, a couple of different funds have actually returned money to investors because they haven't been able to deploy the money based upon the yields that they were trying to get because they had anticipated yields up here, and now to be competitive, you've got to be down here. They've given, we're talking about hundreds of millions of dollars back. So I think there's plenty of money in the marketplace. I'll let Michael talk about investors' attitude in the market, but my God, I would never have believed that cap rates would have stayed as strong as they have stayed, even for retail. Now, once again, the story of the haves and have-nots, but whether it be a single tenant net lease deal or retail deal, haven't seen too many office deals trade, quite frankly, but it's been amazing. So I would say that by the end of this year, I'm really excited to see where we are with this marketplace. It doesn't mean that lenders are going to take the wraps off and put dollars on anything. I think the one thing we learned moving into the great financial crisis was that leverage can kill you. And so they're going to underwrite appropriately. And we're starting to see them take some account of improving rents in multifamily. The agencies are getting a little bit more aggressive, but they're not going to go overboard. So don't think that it's going to be a panacea out there and you can be able to get whatever you want. I think once again, as I've said earlier, it's a story between the haves and the have-nots. So if you've got the right property, you can finance it. You can finance it aggressively up to, depending upon how you structure deal, 80 to 85% is not going to be unheard of. And I think we're going to get back to pretty normal market. And then you got interest rates, which I'm not going to talk about today, but how far is the 10-year going to move up as there's talk about inflation and all this stuff happens and stimulus into the economy. So many issues.
Well, thank you. That was actually really good. And I'm hearing consistently, same thing you are, is that there's a lot of capital available, almost too much. And sometimes that can be misleading if you're the one needing it, right? Michael, yeah, you're a really good indicator of buyers' temperature and how things are viewed out in the marketplace in general. So
Where I get gas on my boat, sometimes I have a performance boat, and the guy will say, "How much gas are you getting?" I'm like, "I'm filling up." And one day I asked him, "Why do you ask me how much gas I'm getting?" He said, "Michael, when you come in here and get half tank, I'm selling everything. I'm selling out your indicator." I said, "I don't think that's a good indicator." But I think there's headwinds and there's tailwinds, but then I think there's something else that could hit us. I think we've got the tailwinds of all the capital, all the enthusiasm. I think people want to get back out. They want to be active. I think it's going to get the economy rolling. I think the headwinds are just the shutdowns and the overall impact of that's going to have on the economy and on jobs. And I think the increase in taxes that has to come along here, corporate personal taxes. But I think the crosswind that could knock the boat over can be the 1031 exchange. If that comes out of the blue and it hits us, then I think we could have that second hit where, okay, now there's problems with values. That's going to be a sea change in the amount of capital rolling around. So I think as long as we don't have that hit the boat, I think we'll have a good, strong recovery.
Can you explain the 1031 issue? for anybody on this call that may not know?
Yeah.
Just to,
So our president had said that he was going to either do away with or significantly change the 1031 before when he was running. And if you look back at his tax plans, the 1031 was really on the hit list. Now it's been around 100 years. Obviously, it helps our economy in big ways, but I think Congress can look at it and go, oh, well, look at those immediate tax savings. We need that money, and not think through what the overall impact would be to the economy and to jobs. So I'm hopeful that nothing happens to it. But it's certainly, if you look back at his agenda, it's there.
okay. Will?
I'm really optimistic about obviously lodging, restaurants, reasonably optimistic on retail and commercial or commercial office that we'll see at least some more certainty come back into the markets. I think multifamily has been surprisingly performing very well during this period of time, contrary to what intuition, because it's been supported by these by pretty free forbearance, what seem to be free forbearances from the agencies, both Fannie and Freddie. But at some point, the piper is going to have to be paid there. You don't lose a year of rent out of the market without something having to be done. And I think our public policy on how we deal with that is really going to drive the outcome there on multifamily, because you can't just take a year's worth of rents out of some of these markets, and you can't make people pay it back who didn't have jobs, and you can't not pay the owners of the property, because what's going to happen there? So something's going to have to be done public policy wise. If we don't, then I think it could be pretty detrimental to the market over time. But I'm confident we'll come to something. It's just I don't know what it's going to be yet. We can't ignore it.
And I'll chime in on the multifamily market. I've been a broker for 35 years. I started in the multifamily world for many years. I have never seen the multifamily market this hot. The number of offers that come in with hard earnest money day one, no contingencies, buyers fighting, buyers furious that they can't get their full price offer. It's just, I've never seen it this hot. It's just pretty amazing to me.
Wow, that is. We have one more question. Actually, we're getting a couple questions, but I'm gonna give you my prediction or my view of what's going to happen between now and the end of the year. And of course, I probably get really tainted because what we do all day is work with owners that need assistance, but we've gotten there's been a ton of relief and deferrals being given in the marketplace for COVID. So you got all these mostly hotels, some retail properties that's completely suffered, had some cases zero income during COVID. You get a deferral, all that looks good. It all has to be paid back at some point. Well, most of those forbearance terms expire at various times this year. Some get documented, inked, and while they're getting signed, they already are, over. And so I don't know what the tolerance is going to be to kick the can down the road again and again and again. And I'm afraid that we're going to start seeing some things that got a short-term deferral or forbearance might start actually defaulting. So I think we're going to see an increase in defaults this year for those reasons. So I don't want to end it on a bad note, but that's what I see. Well, somebody asked, and I don't know the answer. Any of you that I don't suspect, Will, you know this either. So maybe Bill or Michael. Somebody asked, what are the kind of terms you're seeing in traditional financing today? I just don't deal with that. So anybody know the answer there? I know it depends, but in general.
There's a broad array of terms. There's 3-year, 5-year, 10-year. You can go to a life insurance company and do a 25-year, even a 30-year, certainly the agencies. And it's still, even though rates have gone up a little bit over the last 60, 90 days, it's still historically low cost of debt. I would certainly say as a sort of an ex-debt guy, now's the time to finance a deal if you can finance it. So you've got to pair the cost of debt, which is pretty inexpensive, off against maybe a little bit more conservative underwriting approach. And can you get the dollars you want? And then you've got to think about, if you need more dollars, you want to combine, combine mezz on top of it and structure it sort of an A-B situation so you can get higher financing. But the cost of debt overall is incredible.
Okay.
I'm seeing some interest rates on some acquisitions at 3%, 4%. I saw we closed a small $3.8 million office building last week, and they got 80% loan to value on a regular office building at 3% from a bank. And the same borrowers buying a portfolio of buildings that are around 18 million, the debt is the same quote. Now, this is a very solvent, experienced buyer, but incredible debt. And these were regular office buildings too. But the difference, I would say, is that they were suburban 1 and 2 story separate entrance in suburban markets in metro Atlanta, which you get them some of these metro Atlanta suburban markets, and you think that there was no COVID test. It was like, or they passed it, I guess. They passed it a long time ago. And the companies, these smaller businesses, are in their offices and they're using them. It seems like it's the bigger companies that, hey, there's no way I'm letting my employees in, right? So that those properties, some of those are performing well, even though they're the regular office. So we're seeing really good financing, as Bill said, if you can get it underwritten.
That's great. I mean, that's a positive thing. Question came in about will this be recorded? It is recorded, and I will send it around to all of you that attended, so you can hear it again if you want, or share it. I presume that I already know Bill and Michael are okay with that. So if you should disagree, either of you can shoot me a note, but otherwise we'll have it available. And with that, I want to thank you all so much for attending, and I thank you again, Michael and Bill and Will, for your valuable insights today and taking the time for this group. So hope everybody has a great day. Before we log off, I do want to say that going forward, in addition to Michael's show that he mentioned, I have a new series coming up that's called CMBS 3030. And what I will do is, for 30 minutes every 30 days, I will cover the hottest things that have happened in CMBS over those 30 days. Not statistics you can get other places, but more insight, behaviors, deal terms, and so on. So encourage you all to sign up for those. It's on our website. And anyway, this is the last of our webinar series, and I thank you again, all of you, for attending. Have a great day.
Thank you for having me in.
Thank you.
See you, Will. Bill.
Thanks.
Yeah.